For years, Americans were told the national debt was just a number on a screen, big, abstract, and ultimately harmless. But quietly, without a vote or an announcement, the United States has begun erasing tens of trillions of dollars in debt by erasing the value of the money in your pocket. If you glance at the debt clock in Times Square or scroll through the Treasury's official figures, you're confronted with a number that feels less like math and more like science fiction. The counter spins relentlessly past $5 trillion, racing toward $8 trillion with no sign of slowing. It's a scale so large the human brain struggles to process it. Stack 38 trillion dollar bills, and the column wouldn't just reach the moon, it would sail far beyond it. For decades, this number was treated as background noise. Politicians waved it off. Economists rationalized it. We were told deficits didn't matter, that a country issuing its own currency couldn't go broke, or that everything would be fine as long as the economy kept growing. The debt became like a high score in a video game, alarming to look at, but disconnected from real-world consequences. That illusion shattered in 2024. The math crossed a threshold it had never crossed before, and the debt stopped being theoretical. It became active. For the first time in American history, the federal government began spending more money just to service its debt than it spends on national defense. Let that sink in. More taxpayer dollars now go to paying interest on past borrowing than to funding the military that protects the country today. Interest costs had also surpassed spending on Medicaid. The annual interest bill is approaching $1 trillion, and it is growing fast. This is no longer a bookkeeping issue. It is a structural threat embedded directly into the federal budget. What emerges from this reality is something economists call a debt spiral. In a household drowning in debt, the solution is obvious. You cut expenses. You cancel subscriptions. You tighten your belt. Governments don't have that luxury. Most U.S. spending is mandatory, locked in by law and politics. Social Security and Medicare aren't line items that can be trimmed without consequences. They are promises made to an aging population that votes. Breaking those promises is politically radioactive. So when interest costs rise, the government can't simply cut spending to compensate. Instead, it borrows more money to pay the interest on the money it already borrowed. It's the equivalent of using a new credit card to make the minimum payment on the old one. The total balance grows, the interest bill grows with it, and next year requires even more borrowing. The process feeds on itself, compounding into exponential growth. At this scale, there is no clean escape. History shows that when sovereign debt reaches these levels, governments have only 3 traditional options. 2 of them are effectively impossible in modern America. The first is austerity. True austerity would mean massive tax increases paired with brutal spending cuts. Balancing the budget would require either doubling income taxes or eliminating entire pillars of government spending, including the military or entitlement programs. Any politician who suggests cutting Social Security benefits by even 20 or 30% would be committing instant political suicide. Any leader proposing confiscatory tax rates would be voted out in a landslide. The American economy is deeply dependent on government spending, and yanking it away overnight would trigger an immediate depression. Austerity, in practical terms, is off the table. The second option is outright default. The government could announce that it simply isn't going to pay its debts. Other countries have done this. But the United States occupies a unique position in the global financial system. U.S. Treasury bonds are treated as the risk-free foundation upon which banks, pensions, insurance companies, and international trade contracts are built. If the United States openly defaulted, the global banking system would seize up almost instantly. Credit would freeze. Trade would grind to a halt. Payment systems would fail. This is the financial equivalent of detonating a nuclear weapon. For the issuer of the world's reserve currency, explicit default is not an option. That leaves only one path. The third option is the one nearly every empire eventually chooses because it is the least visible and the least politically painful, the soft default. Instead of refusing to pay, the government pays every dollar it owes, but it pays in money that is worth far less than when it borrowed it. The difference is created at the printing press. This isn't a fringe theory or a secret plot. It is the unspoken policy reality of heavily indebted states. Economists call it financial repression. Its purpose is simple: transfer wealth from savers to the state by keeping interest rates below the rate of inflation. Here's how it works. Suppose the government owes $30 trillion and inflation runs at 5%. In real purchasing power terms, the value of that debt shrinks by 5% in a single year. That's $1.5 trillion effectively erased without raising taxes or cutting programs. Bondholders are paid back in full, on paper, but the money they receive buys less food, less housing, and less energy than it did before. The loss is disguised as supply chain disruptions or temporary inflation, but the effect is permanent. This dynamic marks a historic shift known as fiscal dominance. For decades, the Federal Reserve was considered independent. Its mission was to fight inflation, even if doing so caused recessions or market pain. Today, the sheer size of the debt has inverted that relationship. The Treasury now dominates. Interest rates cannot rise to levels that would truly crush inflation, because doing so would bankrupt the government itself. If rates climbed to 10%, as they did in the early 1980s, interest on nearly $40 trillion of debt would approach $4 trillion annually, more than total federal tax revenue. The system would collapse. As a result, the central bank is forced to tolerate higher inflation and keep rates artificially low. Its independence erodes, and monetary policy becomes an extension of fiscal necessity. This is the hidden crisis. It doesn't arrive as a dramatic crash. It unfolds slowly, quietly. The headline debt number will keep climbing, 40 trillion, 50 trillion beyond, but the purchasing power of the dollar will keep sliding in the opposite direction. The government is gambling that it can inflate away the debt faster than markets lose confidence. It's a dangerous balancing act. Print too slowly and the debt suffocates the budget. Print too fast and inflation spirals out of control. The strategy is to run inflation moderately high, 4 or 5% for a decade or more. That sounds manageable until you understand compounding. At 5% inflation, the value of your savings is cut in half in roughly 14 years. By the mid-2030s, half the real value of the national debt and half the real value of household savings could be gone. This playbook isn't new. You don't need a crystal ball to see where it leads. You just need a history book. After World War II, U.S. debt relative to the economy peaked at around 119% of GDP. The government didn't pay it down through taxes or default. Instead, it liquidated the debt by holding interest rates below inflation for years. The Federal Reserve capped rates while prices rose much faster. Bondholders lost purchasing power annually, and the debt burden shrank quietly. Today's version of that strategy is more sophisticated and far more concealed. Modern financial repression relies on 3 primary tools. The first is the captive buyer. In a true free market, a borrower drowning in debt would be forced to pay higher interest rates to attract lenders. Investors would demand compensation for the risk. But the U.S. government cannot afford that discipline, so it manufactures demand. Through layers of regulation, banks, insurance companies, and pension funds are required to hold treasury bonds. These bonds are classified as high-quality liquid assets, essential for meeting regulatory requirements. It doesn't matter if the yield is negative in real terms. Institutions must hold them to remain compliant. The result is artificial demand that suppresses interest rates, regardless of fiscal reality. The second tool is a distorted measuring stick, the Consumer Price Index. Many government payments, including Social Security adjustments and inflation-protected securities, are tied to CPI. The lower the CPI, the less the government has to pay. That creates an enormous incentive to understate inflation. Over the decades, the methodology has been quietly revised. Substitution assumes consumers simply switch to cheaper goods when prices rise, ignoring the decline in living standards. Hedonic adjustments claim higher prices are justified by improved quality. Together, these changes significantly reduce reported inflation. Using older methods, today's inflation would likely be far higher than officially acknowledged. The third tool is the loss of central bank independence. When foreign buyers scale back purchases of U.S. debt, the Federal Reserve steps in. It becomes the buyer of last resort, creating money to absorb bonds the market doesn't want. This process, known as quantitative easing, suppresses yields and keeps government financing costs manageable. But it also floods the system with liquidity, inflating asset prices. Stocks soar. Real estate surges. Everything appears more valuable. Yet it's an illusion. Prices rise not because assets are more productive, but because money itself is worth less. The verdict is stark. The United States is not going to default outright. It is going to inflate. Interest rates will remain below real inflation for years. If your savings earn 4%, while real inflation runs at 8%, you are paying the national debt for the government. You become the donor class. Opting out requires owning assets that cannot be printed. This process doesn't affect everyone equally. It is the engine driving widening inequality. New money enters the economy through financial institutions, not households. Those closest to the source benefit first, before prices adjust. By the time wages rise, inflation has already eroded purchasing power. This dynamic explains the divide of recent years: soaring asset values for the top, stagnation and strain for everyone else. The middle class is quietly being liquidated to service the debt. The implications for saving are profound. The old model, work, save cash, buy bonds, was built for a world where money held its value. In an era of fiscal dominance, that model fails. Cash guarantees loss. Bonds guarantee erosion. To merely preserve purchasing power, individuals are forced into risk assets. The economy becomes a casino where safety is punished and speculation is mandatory. And there is one more tool waiting in the wings: central bank digital currencies. Physical cash provides an escape valve. You can withdraw it, hold it, opt out. A fully digital currency removes that option. It allows authorities to impose negative rates, expiration dates, and direct controls over spending. The shift toward cashless systems is not about convenience alone. It is about control, ensuring there is no exit when the wealth transfer accelerates. The conclusion is unavoidable. This is a default, slow, administrative, and disguised, but a default nonetheless. The debt will not be repaid in real terms. Those who hold scarce assets will weather it. Those who trust savings accounts and promises will not. The era of saving your way to prosperity is over. The era of asset survival has begun.